The stock market today appears unshakable. It climbs higher week after week, as if gravity has simply stopped applying to finance. Yet every fundamental signal, every historical pattern, insists that this market should have already cracked. Debt is rising faster than income. Consumers are stretched thin. Corporate earnings wobble. And still, somehow the indexes keep printing new highs. We are living inside a market contradiction. A contradiction that feels stable only because people have forgotten how instability actually behaves. Markets don't crash when the data turns red. They crash when confidence snaps, and confidence always lasts longer than reason. I study markets the way a historian studies collapsing empires, not by asking when the fall will come, but by asking why people stop seeing it coming. And today, we're witnessing the same illusion of safety that has preceded every major financial unwinding of the past century. The numbers say decline. The behavior says euphoria. And when those two conflict, history tells us that the numbers always win. But make no mistake, this apparent stability isn't organic. It isn't natural. It isn't even accidental. It is engineered, upheld, supported by three hidden forces that almost no one talks about openly. Forces powerful enough to delay a downturn, yet fragile enough to make the eventual correction far more violent. These forces are a relentless flood of government spending and silent monetary expansion that inflates asset prices from the top down. A dangerous concentration of market growth in a handful of tech giants, boosted further by the mechanical buying of passive investment flows. And a regulatory loophole so vast that major banks use it to bury their riskiest exposures deep within the shadows of the financial system. Together, these forces create the illusion of a market floating above reality. But illusions don't last. They stretch until they break. And the longer they stretch, the more devastating the break becomes. In the next section, we'll uncover the first and most misunderstood pillar holding up this market: the silent transfer of wealth fueled by government spending and monetary debasement. This is the engine behind the illusion. And once you see it, you can't unsee it. If you want to understand why the market refuses to fall, you must follow the money, not the headlines, not the forecasts, not the optimism. The money. Because the first force holding this market aloft is the quietest, slowest, and yet the most powerful one: government spending fused with monetary dilution. Here's the uncomfortable reality most investors prefer not to confront. The United States is running the largest peacetime deficits in its history. Trillions flow out of the Treasury and into the economy year after year. And while the Federal Reserve claims to be tightening, the financial system still swims in liquidity created over the past decade. This is not an accident. It is a mechanism. When the government borrows on an unprecedented scale, someone must absorb that debt. And the Federal Reserve, whether through direct purchasing, reinvestment, or engineered liquidity, ensures that the system always has enough fresh dollars to keep the wheels turning. This isn't classic money printing. This is digital dilution, a slow-motion erosion of purchasing power disguised as economic stability. But this dilution is not evenly distributed. That's the part they don't teach in school. New money reaches the financial system first: the government, the banks, the asset managers. By the time it reaches ordinary people, its value has already declined. Economists call this the Cantillon effect, but you can think of it as a 300-year-old cheat code. Those closest to the money printer win and everyone else plays catch-up. And who exactly benefits? The top 10% of households, the ones who own almost 90% of all stocks. For them, inflation is not a threat. It's a feature. As the dollar loses value, the price of their assets rises. On paper, they become richer, even if nothing in the real economy improves. Meanwhile, ordinary workers feel the opposite. Their savings lose purchasing power. Their wages lag behind inflation. Their rent climbs. Their groceries climb. Their debt grows heavier. This isn't a flaw in the system. This is the system. And the stock market? It becomes the scoreboard of this invisible wealth transfer. Asset prices rise not because fundamentals justify it, but because the currency beneath them is being quietly weakened. This steady flood of money props up the market from below. It delays the correction. It numbs the fear. It convinces people that maybe this time really is different. But history tells us it never is. And this is only the first force keeping the market alive. The second one, far more precarious, is the concentration of almost all market gains in a tiny cluster of mega-cap tech giants, amplified by a structural shift in how modern investors deploy their money. To understand the second hidden force keeping this market unnaturally stable, you need to look not at how much the market is rising, but where the rise is coming from. Because today's bull market is not broad, not healthy, and not diversified. It is perilously concentrated in a handful of titanic companies whose valuations stretch far beyond historical precedent. This is the illusion of strength created by size, the kind of illusion that makes an empire look invincible just years before it collapses. We've entered an era where a tiny cluster of tech giants carries the entire market on its shoulders. Their valuations are priced for decades of flawless growth. Their earnings assumptions are stretched across the horizon. And investors are paying $20, $30, even $50 for every dollar of earnings as if the laws of financial gravity simply dissolved. But the danger doesn't stop with concentration. It's amplified by something else, something mechanical, automatic, and unstoppable. The dominance of passive investing. For decades, markets were driven by active decisions. Analysts choosing companies, managers weighing risk, investors picking winners and losers. But today, more than half of all investment dollars flow into passive index funds. These funds don't analyze. They don't evaluate. They don't think. They buy whatever the index tells them to buy. And the index is dominated by the same tech giants already inflating the market. The result is a loop, a feedback cycle. As these megacaps rise, their weight in the index increases. As their weight increases, passive funds must buy even more of them. As passive funds buy more, prices rise again. And the cycle repeats, mechanically, relentlessly, blindly. This is not investing. This is momentum automation. And it creates a dangerous illusion, because as long as passive inflows continue, the largest stocks cannot fall. But when the tide shifts, when markets turn, when fear returns, when investors finally move to cash, passive funds are forced to sell in exactly the same mechanical way they once bought. Only this time the effect runs in reverse. The biggest stocks fall first, fall hardest, and pull the entire market down with them. This is why modern crashes happen faster, sharper, and more violently than those of the past. The same structure that lifts the market accelerates its collapse. We are standing on a narrow pillar of overconcentrated growth supported by a river of automatic buying. And pillars like this don't gently decline. They crack. But there's a third force, the darkest of them all. Because even as the market rises and the banks appear stronger than ever, the riskiest assets have been quietly moved off the balance sheets of regulated institutions and into the shadows. If the first force is the money flood, and the second is the mechanical momentum of concentrated tech growth, then the third force is the most deceptive, and the most dangerous. It's the one Wall Street hopes the public never understands. The quiet transfer of risk from regulated banks into the shadows of the financial system. After the 2008 financial crisis, regulators introduced sweeping reforms. Laws like Dodd-Frank were designed to make the banking system safer, more transparent, more stable. And on the surface it worked. Large banks today present themselves as fortified, liquid, conservatively managed. But what most people don't realize is this. The stability is real only because the danger was moved somewhere else. Instead of holding risky loans and leveraged products on their own balance sheets, where regulators could see them and demand capital buffers, major financial institutions found a workaround. A legal detour. A door slightly left open. That door leads into the shadow banking system, a sprawling world of non-bank lenders, private funds, structured credit vehicles, and opaque financial entities that are not held to the same rules as traditional banks. They don't face the same stress tests. They don't carry the same capital requirements. They don't disclose risk the same way. And yet they hold trillions in assets tied to some of the most fragile corners of the economy. This shadow sector now carries the leverage, the default risk, and the volatility that used to sit inside regulated banks. On paper, the banks look clean. In reality, they have simply outsourced instability. It's a modern version of regulatory arbitrage, a system where institutions appear safe because someone else, someone outside the spotlight, holds the actual ticking bombs. And here's the paradox. As long as nothing goes wrong, the structure looks brilliant. Banks show strong balance sheets. Regulators celebrate. Investors relax. Markets climb. But when something does go wrong, when defaults spike, when credit tightens, when liquidity dries up, the losses don't stay in the shadows. They come rushing back into the mainstream financial system like a shockwave. That's how contagion works. It always finds its way home. This is why the current period of stability feels so fragile. Because it is. We live in a system where risk is not eliminated, it is hidden. Where safety is not earned, it is performed. Where stability is not structural, it is staged. And once confidence breaks, hidden risk becomes visible instantly. Every illusion collapses at the same speed, all at once. All three hidden forces, the money flood, the concentration of market gains, and the shadow transfer of risk, Create something that feels like stability. Not real stability but the appearance of it. And appearances are powerful. They keep people calm. They keep markets afloat. They convince investors that danger has passed, that warnings were exaggerated, that maybe this time the rules have changed. But that is the single most dangerous belief in finance. The belief that this time is different. History shows us the same three-stage sequence before every major unwinding. Stage 1. Irrational endurance. Markets stay elevated far longer than fundamentals justify. Investors begin to believe the rise is permanent. Warnings are ignored. Red flags become background noise. Stage 2. Crash fatigue. People get used to bad news. Layoffs, inflation, debt stress. Nothing seems to matter. Markets stop reacting. Complacency becomes the norm. This is the quiet before the storm. Stage 3. The confidence break. It always comes suddenly. One event, a default, a liquidity freeze, a disappointing earnings report from a company too big to fail, triggers a chain reaction. Selling accelerates. Passive funds amplify the fall. Shadow risks return to the surface. And the crash that should have happened months ago appears almost overnight. This is why delay is dangerous. Crashes do not get smaller when postponed. They grow. They accumulate pressure like a fault line beneath the earth, waiting for the smallest fracture to unleash everything at once. And when the system finally snaps back to reality, the correction won't be gentle. It will be fast. It will be violent. And it will expose how deeply this entire cycle depended on confidence, the most fragile asset of them all. But here's the part that history whispers to those who pay attention. Moments of collapse are also moments of transformation. They destroy, yes. But they also reveal opportunity, the kind that only appears when leverage unwinds and forced liquidation resets prices to rationality. Understanding the structure of the system is the first step toward independence. Not fear. Not panic. Understanding. Because financial sovereignty begins long before a crisis. It begins with knowing what the system rewards, what it punishes, and where its blind spots hide. It begins with positioning yourself outside the reach of the mechanisms that quietly erode the wealth of the unprepared. With owning assets that produce real value, land, businesses, intellectual property, and holding forms of wealth that cannot be inflated away or frozen at a keystroke. The illusion of stability is temporary. But the opportunity that follows its collapse is generational. If you want to stay ahead of these cycles, if you want to understand the forces shaping markets before they become headlines, then this is only the beginning. Subscribe to Finance Archives. Because history doesn't just tell us what happened, it tells us what's coming. And in a world built on confidence, knowledge is the most valuable asset you can own.